75% of what a mortgage broker does is before choosing that bank.
I wanted to work with people who had done more than what I had done.
Why rely on luck when I guess you can get someone to do the actual legwork, right?
For free.
For free. For free.
That's crazy.
Wild, isn't it?
We're back. Flamingo Property Investing. Mate, it's been a little while since we've recorded, huh?
Yeah, you've been a busy man, Jack.
We have all been very busy people. I mean, I've been trying to live on $75,000 a year and it's been a fucking jungle out there. Yeah, you see? Jordan Bear, we're back. And today, my friend, we're going to talk about a topic that probably has been spoken about 1,000 times by lots of people, but never from us. And that's really the only opinions that matter in my world. So bank versus broker. Lots of differences. A lot of people may know them. If that's you, stop listening, go and enjoy your life. If it's not you, keep listening and you'll probably learn a thing or two. There is a few differences. We're going to talk through those. The difference between process, the difference between timeframes, the difference between the outcomes that you get generally if you go bank versus broker. We'll talk through our own personal experiences and what would happen if we just went direct to bank versus using a broker. And then we'll talk about whatever else comes to mind because we're good at that. You know, there's a good chance we could end up talking about the gap in the blinds at the top of the room because that's annoying me right now. So, Joel, let's kick it off. What are the main differences with going to a broker versus going to a bank if we start with the process?
Right. Okay, so I guess to get a loan, two methods.
Yep.
The traditional old school method, you go direct to your local bank.
That's what Jack did. ANZ at Windsor.
Windsor.
That was my first line.
Yeah, cool. I went to Westpac at Bondi. Fair enough. So yeah, direct to the bank, whether that's a bank you've got a relationship with, a bank mum and dad knows, someone you know that works there. Go to the bank you deal with and say, this is what I want to do. Can you help me? If they can, fantastic. That person, that employee at the bank will assist you from start to finish, right? Mm-hmm. Alternatively, use a third party, such as a mortgage broker like what we do, or any other broker in Australia. Difference though is when you go to a third party, the broker doesn't start with the bank. Mm-hmm. They start with you, what you're looking to do, and then they use their understanding of all the different banks, products, policies in the market to try to put together a solution that fits you, right? So it's very much tailored to you rather than tailored to a bank in a way. So how we kind of explain it to the clients is it's like the bank has like a box, which is their policies, their requirements and stuff to get your loan approved. If you fit within their box, fantastic, they'll help you. If you don't, sorry, can't assist you, you then kind of walk into the next bank, etc.
Yeah.
How the broker works is they start with you and they kind of then try to draw the box that kind of tailored around you, right?
Because every single bank is different, right? Even
Absolutely.
Though people may see that at face value, like, oh, CommBank is yellow and ANZ is blue and Westpac is red. It's like they're very different with how they look at borrowers, maybe who their ideal client avatar is in a certain market as well, because that would change over time, right?
Yes.
Things they like, things they dislike, things they'll allow, things they'll disallow.
Yes.
So, you know, if you were just a borrower walking into a bank who is very straightforward, earns a certain amount of money, has no debts, you probably go to most banks and they're going to be very similar.
Yes.
But as soon as you add a tiny little bit of complexity in there, like I get paid bonuses, or maybe I get paid through a different avenue, or maybe I've got a company, or maybe I have some defaults in the past, like all of those little things, but adds a layer of complexity. All of a sudden, one bank, or it's highly probable that one bank is not going to be the right fit for you, and you're going to need lots of lending options.
Absolutely. And every individual, their circumstances are going to change over time. Like your circumstances on your first property versus your current circumstances now would be drastically different compared across those two periods, which then means the bank that might have suited you day one would be very unlikely to suit you where you are today, right? So you want to essentially have choice. Like we always say to our clients, like choice is power. You want to be in a position where you qualify for multiple banks and then you get to pick and choose. Whereas, like you said, the probability that you walk into one bank and that bank is going to be the right fit for you is possible, just a lot more unlikely compared to doing a bit of legwork to kind of make sure it is the right bank for you.
And another thing that we've found as well with processes, if a client comes to us, generally they come to us without finance and they're going, hey, Jack and team, this is what I want to do. How do I do it? And if we said to them, this is the portfolio plan, this is how you're going to build wealth over the long term, this is how finance needs to be structured, hey, just go and chat with the local bank branch down the road and just relay all this information to them. The reality of that lender inside of the branch knowing what the fuck we're talking about is almost 0%. Like most of these people don't even own property.
Yeah.
You know, they've never bought investment properties. They don't understand structuring. So it's very, very challenging to work directly with banks who have never, or people inside of banks that have never done the stuff that we do.
Not always the case, but sometimes you get, you know, a good banker. But like most businesses, high performers usually will rise up the ranks.
Yeah.
You might have a fantastic banker who is like a gun at what they do, could be a high performer, really understands the process really well, really understands structuring really well. But then when that banker moves on, then you've got a new banker that gets replaced. And then you got to rebuild that relationship. You got to relay all your information to that person. Whereas I guess usually if you're using a broker, and especially a lot of brokers in the market, they're usually like self-employed, or sole operators, or like within a small business where they might get paid very differently to a bank, and it's in their best interest to kind of maintain that relationship. Then you don't have to kind of keep relaying your information over and over and over to the same person, to a different person. You've got one person that's a sole point in contact that's likely going to be there for a lot longer throughout your journey than, say, someone who might work as a banker for a couple of years, get promoted, and then
all of a sudden you got someone new in there.
Correct.
Yeah.
Correct.
So the actual process from a customer's point of view, you're like, let's say you go to the bank versus go to a broker, they're going to ask for very similar documentation, correct?
No. Oh, yeah, similar, yes, but also sometimes, I guess from our perspective, a broker might ask for more than what a bank would. So from our side, I guess, I'm not sure about other brokers in the market. I'm assuming a lot is quite similar to what we do. We will normally ask for enough documentation that will cover all banks. So let's say you walk into a CBA, that banker at CBA is going to ask you for what CBA needs. Mm-hmm. Now, if you walk into ANZ, what ANZ might need could be slightly different to what CBA needs. And then again, if you go to Westpac, then again, slightly different again. So if you come to us, we're going to ask for enough stuff that covers all lenders, which is probably likely going to be a little bit more in terms of detailed documentation compared to if you walked into a single bank. And the reason we do that is because then at that stage, because we haven't chosen a bank for you, because we don't actually know until we go through that analysis, we want to make sure that we have all the information. So then when we do choose a bank, we don't have missing bits of the puzzle. So usually the upfront documentation could be a little bit higher, but then throughout the process, when we decide which bank, let's say we are going to go to CBA, we'll only give CBA what CBA needs and not the stuff that other banks would need.
Would require.
Yeah.
Yeah. So you guys will request everything you need to go to most lenders.
Correct.
And if you do need some extra stuff along the way, because you go to a lender that you maybe didn't expect to go to, you'll ask for that at the point in time.
Correct. And sometimes we do get that feedback. We get a client like, oh, I walked into this bank, they didn't ask for this, right? I'm like, yeah, that's fair enough because this bank's policy doesn't need it. But if we actually went to another bank, they could need it, which is why we've asked for it up front, rather than just getting bits of the puzzle and then realising down the track, oh, sorry, you don't fit that lender because we didn't ask for it at the start.
I always say to our clients as we go through and build out their portfolio plan, that's generally when we'll then refer to brokers. I'll always say, hey, just so you know, this is the most painful part of the whole process because like I've gone through so many finance applications and you have to send so much shit. And the funny thing is people have this perception that, fuck, why does the broker need all of this information? And I'm like, I can assure you, if Jordan didn't fucking need it, he wouldn't ask for it. But it's like the only reason they request it is because when the bank requests it from them, they then have it. And I know a lot of people get frustrated with that process with, regardless if it's broker or bank, like requesting documentation. Like, why the fuck do I need this? Why do you need this bit of documentation? Why do you need this letter from this person to say blah, 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 blah? But they just don't get how stringent lending is, right? And I believe that's a good thing because we saw what the other end of that, which is where they request nothing, and how that ends in the GFC with in the US many years ago. And that's because you could just go and get a loan with no documentation and no proof, and all of a sudden, a global meltdown.
So I would say putting in the extra work at the start usually will result in a smoother process as you go through and a much more superior outcome, compared to trying to cut corners at the start and just providing the bare minimum, then realising down the track the bank's asked for this extra document. we didn't have it, so we can't actually preempt the answer, and then it's a lot more back and forth, etc.
Then you're going back to the client and say, hey, the bank's asked this, can you send me this? Then you go back to there's all that time delay as well. And as you go through the process, maybe you've bought a property already. It's a lot more stressful when you've got a settlement pending versus at the start where you've got no real timelines.
Yeah.
Interesting. So it sounds like the process up front is broker will likely request more information, but the reason they do that is because they want to have all the information they need to go to any lender that could be the right fit versus just walking directly into a bank and they're only going to request the things that they need. But if you went down the road to another bank, they may request other documentation.
Spot on.
Awesome. The other thing you mentioned just before was, well, maybe the way the banker is paid is different to the way the broker is paid. And because of those two things, or those two differences, then how you get treated post that transaction could be slightly different. So run us through, you've been on both sides. You were a banker to begin with, now you're a broker. How does it differ? And if you're working with a good banker versus a good broker, what will that relationship look like
for sure
term?
So I guess as a banker, if you're working for a bank, you're obviously PYG, an employee. You'll get a base salary, not a bad base salary these days, plus then you'd get a performance bonus usually, which is driven by the amount of new loans you can write for that bank, right? It's essentially a sales role by definition.
So how many new customers can you acquire?
Correct. So let's say let's say your target's to write 50 mil worth of loans a year. You write the 50 mil, you get a bonus, and then obviously everything on top, there's usually like a tiered agreement, etc. Right? Now, how a broker gets paid, which I guess there is still a bit of misconception in the market. A lot of people think a broker is a service that you need to pay for on top. Which is fair. Like if you go see an accountant, a financial planner, or
Henderson Advocacy,
a lawyer, you might have a fee, sometimes a few thousand, sometimes tens of thousands. Whereas I guess how we work is we don't charge, as a mortgage broker, we don't charge for our service. Some brokers might charge something on top, but most brokers won't charge for their service. And how we get paid is we get paid direct from the bank. And how I explain it to our clients is, people, I guess, in the construction industry normally understand this quite easy. It's kind of like having a subcontractor versus a PYG employee, right? So if you walked into CBA and that employee at CBA was assisting you, if you went to a broker and that broker also went to CBA because CBA was the right bank for you, they don't just become a middleman and give your documents to that CBA employee. That broker essentially becomes that employee, so they'll have access to CBA policies, have access to CBA calculators. They will do all of the things that that banker would have done on behalf of CBA. But at the very end of the process, CBA still issues the loan. CBA still gets paid the interest that you will pay as a client to the bank, right? But now, in that example where you've gone to that mortgage broker, CBA no longer has to pay that salary to that employee. So instead of paying the salary to the employee, that bank will then pay the mortgage broker a commission, and that commission essentially is no cost to you as the client, right? Now, how we get paid then as a commission is also, in my opinion, a lot more aligned with the customer's best interest. So we get paid as a mortgage broker two types of commission. We get an upfront commission, which is across majority of banks 0.65% on the net loan amount. So if you borrow $1 million and you put $500,000 in your offset account from day one, that broker will get paid 0.65% on $500,000, right? So that's $3,250, right?
Because the other $500,000 is sitting in offset and not actually drawn down on.
Correct. Correct. Now that.
So brokers love when clients do big refinances and put them in their offset account.
Yeah, sometimes fully offset, you don't get paid, right? Now, that commission that broker receives has usually what's called a clawback period. Most banks is 18 months. So let's say I said, hey, Jack, let's go to bank number one. We believe it's the right bank for you. We get the loan done. We get paid the $3,250 on a $500K loan. And then 17 months down the track, you realize, fuck, that was the wrong bank for me. I should have gone to another bank. And then you close your loan, or you refinance to another bank, or you sell your property. That broker can pay up to the full commission back to that bank. So it's almost like a grace period to make sure the broker's acted in your best interest, right? The second commission the broker then gets is what's called a trail commission, which is 0.15, again, on the net balance. So on a $500K loan, they get $750 per year that loan is active. Now, if you compare that to the banker gets paid a fixed salary. They get a performance bonus on top based on the new loans they write and receive, right?
But not based on the client and how happy they were, just
Correct.
Based on how many loans they write.
So if you walked into a bank, the bank said, hey, Jack, I can do this, promise you I can get you the outcome, and then for whatever reason you weren't happy with it or you didn't get the outcome you wanted, or that you weren't happy with the communication or the service provided, and then you realize you don't want to use that banker and you've gone to another bank, that banker still gets paid. From the moment you've engaged a mortgage broker, any time that mortgage broker has spent with you, they don't get paid all the way up to when they get the loan settled for you. So if they promise you the world and then they can't deliver and then you pull out for whatever reason, they don't get paid, right? So they're very much on the same page as you. If you get your outcome, they get paid. If you don't get your outcome, they also don't get paid, right? I guess logically speaking as well, if you pull out for other reasons, like again, like you're not happy with the service provided, they don't get paid, right? So they're very much more incentivized to ensure they do the right thing by you and provide you more likely a level of service in line with what your expectations are, because that's how they get paid. Then on top of that, even if they have delivered, they have a pretty long period of time that if they don't continue servicing you and you leave, they still don't get paid for the work they did potentially.
And it's actually worse
months.
than not getting paid. They get paid and then they get it taken back off them.
Correct. Plus, they've now invested the time, right?
It's like giving someone some cake and saying, hey, you can eat this, but then I'm going to need you to throw it back up and give it back
12
to me,
months later. And it's not a few months. It's not like a 30-day grace period. It's a pretty long time, right? A lot of banks, if it's closed within 12 months, you pay the full commission back, right? Then that trail commission that they get, on the flip side, if you get a good mortgage broker that looks after you, that trail commission they get, if you've got a 30-year loan and they service you well and they're always there for you, they kind of guide you through that whole journey, they get paid every single year that they're with you.
$750 though, yeah?
Yeah, on a 500K loan, right?
For context, like $750.
Now, if you compare that though to the banker, that banker doesn't get paid a continuous amount. They get paid based on new business, right? So Jack, you could be, when you're the banker's client, top priority, they get the loan done, you form part of their KPIs to get their bonus. When your loan's done, they don't get paid further as part of their KPIs unless you get more lending, right? So if you come back and say, oh, hey, I'm not happy with my repayment types, I had a question, what happens if my interest rates, this or that? They'll probably reply, but are they likely to reply to you first or the next guy that's about to get a new loan?
That's right. Yeah,
Whereas from the mortgage broker's perspective, we would probably see a new client, or we would see a new client and an existing client very much as equal because we're still getting paid on both fronts. And if anything, I guess, if the existing client leaves us, that's commission we've already earned and then we're going to lose, right? So again, very much more aligned with the customer's best interest. On top of that, I would also then say with a mortgage broker, when we get paid that upfront commission plus that trail, after that clawback period has ended, if we actually refinance you and take you to another bank, we can get paid again. So if you compare it to the bank, if you go to a bank and the bank's got you the loan today, in 2 years' time, if there's a better deal on the market, CBA is not going to call you, be like, oh, hey, did you know Westpac got this great deal? It's going to save you 30 basis points. Why would they, right? The broker's perspective, I got Jack the loan at CBA. It's been a couple of years. We've done a review on his loan. We realised we can save you money at Westpac. If we move you from CBA to Westpac, we get paid again. So it's, again, very much in our best interest. If we can save you money, we would move you because then we, again, would then get paid. Yeah.
Which makes a lot of sense.
Correct. So if you have a 30-year loan, you do that 10, 15 times, the broker gets paid pretty well, right? They get paid every single year, that's $750, assuming it's a 500K loan. And then on top of that, they might get a few upfront hits every time they move you from bank to bank if they save you money, because then they get paid again.
But hypothetically speaking, which I would be the worst client for a broker because I'm constantly refinancing, changing lenders. So if I do a loan now and then a loan in 12 months' time and I refinance the loan the broker did last year from one lender to another, the broker's then going to lose the commission they got with one bank, but they will get the commission with another lender. So they're actually doing double the amount of work for the same amount of money.
Correct. But your loan size is pretty big, so the amount of trail they get along the way, that's probably going to make up for it. Yeah.
That's good.
Yeah.
The juice.
The juice.
The juice. Okay. So it sounds like bankers are incentivized to generate new business because the more business a bank has and the more market share a bank has, the better it is for the bank. And they know the majority of the people are lazy and they don't want to provide all the documentation again, and they don't want to do all the stuff. So once they get a client, they would know what the lifetime value of that customer is, right? Hence the reason they probably don't service them all that well. And often we see with banks, it's like they offer new customers better deals than their current customers because, again, that like, show me the incentive and I'll show you the outcome. So it's like the incentive is we want new customers, we'll treat them better than our existing customers because we know once someone's a customer, it's a pain in the ass to go to another lender to try and save a couple of bucks a while. We look after them as well as new customers. There you go.
Spot on.
So where brokers are incentivized to go, hey, well, if I can get this customer a lower rate, a better valuation, which we're going to talk on, maybe some equity out, that's a really good outcome. And guess what? Because I got them an outcome, I get a really good outcome, which is I get paid.
Correct.
Cool. So
on that, before we go on the next topic, probably also worth noting the broker's commission, which is that 0.65 and that 0.15, the upfront and the trail, is completely independent of the rate the client pays and the fees the client pay, right? So if the client pays 6% or they pay 6.5%, where commission is still based on the loan amount. If the client chooses an offset account, they pay an annual fee, or they don't choose an offset account, they don't pay an annual fee, no impact on the broker's commission. Whether the client goes to CBA, Westpac, ANZ, NAB, any other kind of the tier 1 lenders, again, doesn't matter what rate you pay, doesn't matter what fees you pay, what bank you choose, the commission is just based on the dollar value that you net borrow.
Yeah. And essentially that's just coming out of the bank's margin.
Correct.
The bank makes X amount of dollars
cost of goods, right?
That's right.
Yeah.
So instead of paying their staff to generate that business, they've paid a broker to generate that business. So it's no different from the bank size. But actually curious on that, why are banks like CBA so bullish on self-generated business versus broker-generated business? Because I know like CBA are pushing hard to like fuck brokers off, right? Like cut out brokers. That's the reality.
Yeah,
they want to generate all the business themselves. Like why do you think that is?
I think CBA...
And just I mean, they only made $11.5 billion last year, wasn't it? Net profit. Like, fuck me. How are they living on that?
CBA, I guess, in the broker world probably doesn't have the best reputation because of a bit of back and forth of sometimes they're we're very pro-broker, sometimes we're potentially not. And you get some mixed feedback.
CEO-based thing?
Yeah, he's got his own opinion, I guess.
Yeah.
Which we can discuss offline.
It obviously comes from the top down, right?
Yeah. So CBA, I guess, because they've got a huge branch network, I guess my view would be they want to kind of drive and utilize that network, right? Whereas there's a lot of other banks and stuff, like Macquarie, for example, that don't have a branch network, that rely a lot more on third party and things like that. End of the day, a bank is still a business, right? And a business is going to drive its own decisions on what they want to do, what they want to prioritize, what they don't want to prioritize. But I think the good thing is with finance, it's a very competitive industry. There's not only one bank in the market. So if one bank decides, hey, this is what the route we're going to take, there's going to be a lot of banks that will pick up the pieces, which will kind of almost dictate what that bank should and shouldn't do or can and can't do, right? Yeah.
And just so everyone knows the numbers, broker originated loans,
we're
70%?
No, higher now. I think we're close to 80, like 76, 77 on the last check.
Let's hypothetically say 8 out of every 10 loans that are written in Australia from a residential point of view
go to a broker.
There you go.
Yeah. And I would say when most clients find a broker and they understand how a broker works, how they're paid, the benefits of using a broker, and if that broker is good, they would never go back to a bank directly. Yeah.
Very, very true. Valuations.
Yes.
This is a big one, right? Like people are focused on different things. That's great. As you become more sophisticated, as you start to realize that rate may not be the most important needle mover for wealth creation, there could be other things that move the needle. You start to then find different things more important. For me, I want the bank who's going to give me the best valuation because the best valuation means the most amount of equity, and the most amount of equity means I can make more money off that money. So you guys ran some valuations the other day for a couple of properties I'm going to refinance, and the disparity, actually, I'll give you the real numbers. We had 4 valuations run on each property. There's 2 properties, all majors. I'm not going to say which is which, but all majors. This is the first property they'd ever bought, actually. So the lowest valuation, 1.2, second lowest, 1.251, the third lowest, or the second highest, 1.278, and the highest, 1.342. So the difference between the highest and the lowest is $142,000. Now, the difference between the highest and the lowest also is just the color of them, because you can walk into, they both have branches. And if Jack Henderson walked into the first bank, which happens to be the bank that I originated the loan with, so hypothetically speaking, I stayed with ANZ from 2015 to now. I go back and say, hey, ANZ, can you do a val so I can get pull some equity out? they would have given me 1.2 million bucks. And I would have said, awesome, because I wouldn't have known any different. But now the other bank has said, hey, we think that property is actually worth 1.34. And at the end of the day, valuations are speculative because no one actually knows what a property will sell for until it goes on the market. But if they're willing to lend me another $140,000 on that particular property, from my point of view, the risk is on them, not on me. Because if I default on the loan, they're going to sell the bloody thing and they're just got to hope to make sure that they sell it for more than what the loan amount is. So that extra $140,000, which if you look at 1.2 versus 1.342 is like 13%, give or take, 12%. It's a big difference, right? Like you wouldn't be upset with an extra 12% growth per annum, which means I can pull out more equity, which means if I have the borrowing capacity, I can go buy a higher value property or I've got more money sitting in my offset account. Just so people don't think that's just one example, let me give you another example. Second property I ever purchased, same thing, 4 lenders, happen to be the same lenders. The valuations range from 1.328 to 1.52, which is like almost a $200,000 difference. But would you believe that the top lender or the top valuation for the first property is not the top valuation for the second property? So if I just went to the same lender for both properties and were hoping for really good valuations, I would have been let down. So what I now know is I would probably refinance one property with one bank and the other property with another bank because that's the best outcome for me, not the best outcome for the bank. So $200,000 worth of difference on one property and $142,000 on the other.
So 350
$345, or just say $340 odd $1,000 worth of equity difference between different lenders, which is fucking crazy, right? If someone said, hey, here's $340,000, would you say yes or no to taking it? Yes. So that's the difference in vals. So run us through how you go about your valuation, model, because that's one of the things you do, right? You go and run multiple valuations on the one property to see which one's going to get the best outcome. And why do you think they are so different?
Yeah, of course. So I think, like what you said, sometimes we get clients, they call us, they're like, ANZ has the best valuations. And that might be because they had one scenario where they had one property, they went to 3 banks, ANZ valued their property the highest. Now they've got this perception, ANZ has the highest valuations. But in reality, it was just, in that scenario, the value that ANZ used had happened to value your property higher at that point in time. Now, 3 months later, the bank with the lowest valuation could re-engage the same valuer that ANZ had used, and again, it could have come in higher, right? So we normally say with valuations, it's not bank-based, it's the valuer that the bank has chosen to use.
And that is a big misconception as well, just on that. People think, and we have clients say it all the time, the NAB valuer or the Macquarie valuer, and it's like, no. They don't have valuers. They put it out there into the market, and then valuation companies pick it up, like CBRE or Preston Rowe Patterson or whoever it is. So it's not actually the bank valuing the property, it's a valuer valuing the property on behalf of the bank, and then they then assign that valuation to the bank.
Correct. There are some scenarios where banks have their own internal valuations and stuff, and that is, I guess, based on the bank's like internal algorithms and
like
data,
desktop valuations,
automated vals. But yeah, if it's a full inspection valuation, it's usually a third-party professional that the bank engages. And that how we explain to clients how valuation works, if it's like an inspection valuation, or we call them a short form valuation in residential world, is if you imagine, let's say that there's 6 valuers, right? It's the 6 biggest valuers that value all the metro suburbs in Australia. Now, that valuation report usually 6 to maybe 10 pages long, and the bank doesn't see the property. They rely on this 6 to 10 page report to lend against. So they want that report, number one, to be, I guess, not biased, as independent as possible, and as reliable as possible, right? So when we order a valuation, or when a bank orders a valuation, it goes into like a system, and the system will allocate that job to one of the 6 valuers. So let's say you walk to bank number 1, they allocate the valuation job to valuer A, right? Now, once it's been allocated to valuer A and that report is done, you can't go to bank number 1 and be like, oh, hey, I know that another bank valued the same property using valuer B and it came in higher, because that's going to potentially allow for manipulation, right? Let's say Jack's the client, Jack's brother's a valuer, your brother's doing you a favor or trying to do something, and then you go to the bank and say, hey, can you use this value and you get it done with your brother, and then obviously it's not really independent, and the bank's going to have a lot of risk exposure, right? So that system, once it's allocated randomly...
And I'd be worried if it was my brother, because he drives excavators, and if he was valuing my properties...
20 mil.
This apartment, nice high ceilings, 6 mil. Bro, I paid 600 for it.
Once it's allocated, it can't be changed for that reason.
In commercial world, slightly different, right?
In commercial world, they go out to tender quotes and stuff a little bit different.
So that's interesting, is like we're getting a property valued at the moment, and you can actually go out, find out which valuation companies are on the panel of the valuer of the bank. And then, for example, if you have the 5 or 6, broker would say if there's 5 or 6 lenders that would have an appetite for this deal, you go order the valuation yourself as an independent, and then we can actually try and reassign that valuation to the bank that we think ends up having to...
Yeah. Once it's allocated, you can't change it, and that's the reason why. But if you then imagine you go to bank number 2, and let's say there's 6 valuers, you've got now a 1 in 6 chance it's going to go to a different valuer to bank number 1. Then if you repeat that process to the third bank, again, you've got 1 in 6 chance, and as you imagine, the more banks you use, the more likely you're going to hit a different valuer, right? You could be unlucky. Sometimes we've had scenarios we order 4 valuations, it's gone all to the same valuer, right?
And that would happen in smaller towns and stuff, right? When there isn't that selection of valuation firms. Yeah,
correct. Now, with an inspection valuation, how we view it is, we view it as it is a person that goes out there. Mm-hmm. The value that they state is their opinion. The research they do is their research, right? So me and you could go look at a house. We've got the same systems to kind of compare properties. The properties you're going to use to compare versus what I'm going to use to compare, because we're human beings, is unlikely going to be identical, which then means your opinion could be different to mine. Now, we don't normally say, hey, you want to just go to one bank and use one valuer, because we don't believe when you're putting someone's financial kind of wealth at risk, you don't want to just relay that on one person's opinion. So the process we would do, especially for property investors and stuff where equity is very important, the first thing we do is, if they have property, we order multiple valuations. So if we order 5 valuations, the likelihood we're going to get a range versus just one valuation report is obviously substantially different. And then, like you just said in your example with 4, we don't know which is going to be the lowest, which is going to be the highest. But if we get that data, we can go to the client and be like, hey, you thought your property is worth 1 mil. Just as an FYI, the lowest valuer thinks it's worth 9. The highest valuer thinks it's worth 1.2, right? Now, ideally, if you do qualify for the bank that has the valuation at 1.2, you get a drastically different outcome. And then again, if you imagine what that looks like, if you've got 5 properties and you're doing that 5 times, you add those little variances along the way.
350 between 2 properties, right? It's massive.
Yeah. I recently did mine. I revalued 4 properties. There's $2 million in difference in the lowest versus the highest. I had to go to different banks. It was a bit of a pain in the ass, but it allowed me to pull out a bit of cash and, do some silly shit.
That's right. Buy a Lambo.
Yeah, so it's worth going through that exercise. Yeah. And I'd probably then know...
And that's the difference, right? You go one bank, one valuation, one outcome.
Correct.
Which is not the greatest.
And I guess that's probably another thing worth touching on versus bank versus broker, where sometimes we do get this feedback as well, is when a client's just only dealt with the one bank, sometimes things will move faster. And the reason it moves faster is they don't go through that process of comparing all these different options. They just go straight to, hey, this is the bank I work for. This is the valuation my bank's going to give you. This is the outcome I'll give you. Whereas 75% of what a mortgage broker does is before choosing that bank. So the process is completely different. So if I'm ordering 6 valuations, waiting for the 6 valuations to come back, then saying, hey, Jack, this is the bank I present you, versus, hey, I've just got one bank, we're going ahead, the time frame is going to be drastically different. So usually if you want a bit more of a structured, superior outcome, it will take a bit more time. But that's because you're comparing heaps of options versus solely looking at one.
Let's hypothetically say it takes an extra week and a half, 2 weeks, right? I know my time's worth a fuckload of money, but I can assure you 2.5 weeks or 2 weeks of waiting is not worth $350,000, of which I didn't do anything. I just sat there and waited. It's crazy, right? So that's the big difference, is valuations are a very, very big piece of growing your wealth. And we renovate a lot of properties. We want multiple valuations because we know some valuations that come through on renovated properties, sometimes they just go, what'd you pay for the property? How much you spent on the reno? That's what it's worth.
That's it, yeah.
And it's like, oh, is it really?
Yeah, do you remember that client you had in Queensland? There was a purchase and we had a automated val that was like $1 million above purchase price. Do you remember that one?
Yeah, in Albion.
Yeah,
in Brisbane.
Yeah. So if you went to a bank that ordered a in-person val, It would have been on the contract price. It would have been $1 million.
Yeah, so we bought this
euro.
property in Albion in Brisbane. We bought it very, very well.
That was wild.
And we had a valuation done. I think it was...
It was like 800, 900, right?
Yeah, I think almost... We paid early ones for it, or high nines, early ones. I can't remember the exact purchase price, and the valuation come back at nearly $2 million. And the reason for that is because all the houses around it were worth many, many millions. We bought this one unrenovated. Was it actually worth that amount of money if we were to sell it? Probably not. But what it gives us confidence in is if we spend $250,000 on this renovation, for example, which means we're all in for 1.3, we'll then get equity released based on that valuation of almost $2 million to pull out all of our capital.
Go again.
To be able to buy more property. Like that's the cool shit that happens.
Valuations in terms of different outcomes lender to lender is only one of many things.
Yeah.
Borrowing capacity is obviously a huge one. You go to 4 different banks, same income, same expenses, you can get 4 very different outcomes. On top of just your traditional banks, especially for property investors that want to push that envelope and have a bigger risk appetite, non-banks will usually lend substantially more, which you've experienced, right? You go to a bank, you can get $1 million. You go to a non-bank, you can get $2 million, sometimes $3 million. The variance is ridiculous.
Crazy, yeah.
So unless, I guess, you are in finance and you know all the different bank policies, you have access to all the different calculators, you're not really doing yourself a favor by just choosing one lender and ignoring all options. Right?
That's right.
We would never say to a client, hey, you should use this bank and no one else. We would always make that recommendation, but we present it to them. We say, hey, the reason we're suggesting this is we've done the research. This is the outcome you get with all these other different lenders, and this is why this lender is superior. We still will get sometimes kind of like, okay, it's nice to know that, but I do prefer this bank. And then at the end of the day, we'll use them. But at least when you've made that decision, it's an informed decision rather than just, hey, I've gone to a bank, not sure what else is out there, hope for the best. You might get lucky. You might walk into the bank that is suitable for you.
Yeah.
But why rely on luck when I guess you can get someone to do the actual legwork, right?
For free.
For free.
That's crazy.
Wild, isn't it?
The other thing on borrowing capacity, again, like one of the biggest needle movers in property investing, like you go and find another $500, $600, $700 million of borrowing capacity over 20 years. That's not $1 million. That's many, many millions of dollars of wealth. The other thing, which we talk about and have done many podcast episodes on, for people who haven't heard it, go back and listen to all these trusts and company structuring. Policy is very different with every lender. Some lenders will lend in trust. Some lenders will exclude debt in trust. Some lenders won't. Right? So it's understanding which lenders are going to give you those options versus other lenders. And then also, which I always tell our clients, is if you are looking into the next 5 to 10 years, which is what we do for our clients, we plan, you need to understand what the moves look like before you make the moves. Because hypothetically speaking, you go buy your first property in your personal name, use the local bank and go, great, I got my first one, let's go buy my second. You go back to the next, even if you go to a broker or a bank and they say, sorry, you got no more borrowing capacity, or you got very little because you got this one in your personal name, versus going to a broker saying, hey, I want to buy this amount of properties. This is what my future is going to look like from an income point of view. This is where I want to move to, blah, 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 blah. The broker then goes, okay, well, based on that, if they're skillful like Jordan is, this is how we should structure it. You should structure it by going lender A first because they have this policy, then you could go to this lender, then you could go to this lender, and they're looking at 3 or 4 deals ahead, where if you go to a bank and say that, they're like, sorry, what? Like, yeah. I don't get that.
Transaction versus a overall arching strategy.
Planning, that's the big thing.
Huge difference.
And I know with my own situation, I've used many different brokers over my time. I've been working with the same broker now for quite a while. And the big thing is when you start a business as well, like the broker needs to understand your business, where you're at, what your numbers look like last year versus what they may look like next year. Because again, it's planning. So you might go, hey, financials aren't that crash hot this year. Let's go settle this loan through a non-bank lender, for example. But as new financial year comes around, let's then refinance that back from a non-bank lender to a major lender, because you're going to get a lower rate, you might get a better valuation, et cetera, et cetera.
Yeah, could you imagine doing all that yourself?
I wouldn't be able to. I wouldn't know what the fuck's going on. I know now, only because I've done it all myself, right? But when I started, that's why I went straight to the ANZ. Then I did the second thing with the ANZ, and they cross-collateralized the 2 loans. I don't even know what that meant. I was like, fuck yeah, let's go. Cross that shit. And then I found out that it's not a good thing. Only once I went to a broker and I said, can I buy my 3rd property? And he said, yeah, you can, but you got to uncross these properties. Then we're going to take them to another lender, which was a 2nd-tier lender, because I was, getting, in comparison to my income at the time, a lot of debt. Which I would never have been able to do. And the bank actually said no to buying the 3rd property because I didn't have the borrowing capacity with them. So
and
what they were really saying was, no, not with us.
Not with us. Correct.
That's right.
Correct.
What were you going to say sometimes?
Exactly that. Not with us.
Not with us, dogs. So that's a big one, is borrowing capacity, the structuring element, the planning element of like, hey, this is what it looks like in the future. And not every broker is going to do that, because a lot of brokers may not know it, but like really good brokers, like top 3 in the country brokers like Jordan, they know that.
Yeah, you want to make sure, I guess, you have someone that's with you for the whole journey, right? Like similar to, I guess, if you've got an accountant on your team, you've got a good buyer's agent on your team, got a solicitor on your team, you want someone, I guess, in your corner, finance, and as your journey evolves, you want them to kind of be aware of that so they can take you on that journey. Because like I said, I guess earlier on, the bank that suits you today is unlikely going to be the bank that suits you in 2 years, 4 years, 6 years, whatever it's going to be, right?
Yeah, or even at different points in time.
Correct.
Yeah.
And the bank that's, even on that valuation piece, even as of today, the bank that fits you for property 1 may not be the bank for property 2 and property 3. So especially for your clients, when they've got multiple properties, the likelihood one bank is going to fit absolutely everything is almost 0%.
And the interesting thing is that like lending policy changes too with the same banks, right? Like we're starting to see now banks change their buffer rates and how they assess serviceability. So like the bank that may not have been right for you last year all of a sudden may have a different policy now. Correct. It may be the right lender, right? But you don't know that shit because you're not reading emails that come through from the banks.
The fun stuff.
You're living life. That's all very, very good. Are there any other big ticket items that people don't necessarily consider when going bank v broker?
Yeah, I would say where most clients don't see the major value of a broker is early in the journey. So when I've got my deposit, I've got heaps of borrowing capacity, every bank's going to give me the loan approval. It's very much a rate-driven discussion, right? The broker really adds minimal value there, right? Like I said, how we're paid, we might be a bit more incentivized, service might be a bit better, but end of the day, you get the same rates, same bank, same fees after we've done all our research compared to if you walked into the same bank.
Yep.
But when your situation gets a bit more complicated, and it will, assuming you want to build a portfolio, that's where really when 3 banks say no, and then you've got a broker that gets the 4th bank to say yes, suddenly you're like, oh, this broker's, my best mate, right? So it's really, I guess, further on in your journey where the broker can add the most value. And that's where, I guess, when we get clients, when they're buying their first, a lot of the time they're like, oh, you gave me the same outcome as I walked in the bank. I'm like, yeah, because your situation's as simple as it can be. You could get this outcome if you walked into any bank. But again, we want to be there not just for that first transaction. We want to be there for the second, the third, the fourth, the fifth, and all the way through. Yeah.
That's the difference.
So I think it's the main thing of like that relationship piece and having that person, that one point of contact that can do everything for you at all lenders, rather than you've got a fantastic banker today, but then it might not suit you in the future, or that person moves on, then you got to kind of rinse and repeat that process. That's probably the biggest part.
And it's thinking long term, like we always talk about, but most people fucking think in day tight compartments. They kind of think like, oh, it's Sunday coming up. What am I going to do this Sunday or Saturday? Like it's thinking past the first thing.
Yes.
And I often think a big thing that I see people do, which I don't agree with, is they fuck brokers off. Like they work with one broker and another broker at the same time, trying to like play them off against one another. And it's like the dumbest shit that I've ever, or they like go to a broker, get all this information from them, and then they'll go like do something else. That pisses me the fuck off, like really badly, because it's like they know what they're doing. They know these people are not going to get paid. They're wasting all the time and they're just getting all the information for free, and then they go do something else. That's why those people are poor and they're going to stay poor forever. So poor people, stay away. And then another thing, which again, most bankers, you walk in there and you go, hey, Mr. Bank Manager, like, can you tell me about your portfolio? Like, what have you done? Like, how much wealth have you built? Like, the reality is most of them haven't built massive portfolios and a huge amount of wealth. Not because maybe they're not capable of it, but because they're in maybe a career or have an income that doesn't really allow that. And an interesting thing is, because we have a lot of clients who work for banks and then their loans aren't even with the bank that they work with. And I always ask, like, why isn't that? And I was like, oh, well, the bank doesn't really give us that much of a deal or a discount or anything like that. So we just go elsewhere, which is so funny, right? Like people who work at a bank use other lenders to get their debt. That'd be like people working in my organization and then going using other buyer's agents. I'm like, that would piss me the fuck off, which they don't do, by the way. So I think what's really important, and I focused on when I was young younger, was I wanted to work with people who had done more than what I had done, because even though like someone using a buyer's agent, that's the acquisition side of things, you might use a lawyer, that whatever, but a broker is like, again, it's that person with like, oh, I remember when I was in your position earning a similar amount of money and I had 2 properties. This is what I did to be able to get my 3rd, 4th, 5th property through a finance lens. Like that's really important.
Absolutely.
Because you're using the broker not just for banks and policy and lending, but it's also then the experience of what they've done.
Yeah, huge part.
There you go. And that's why Jordan's got 20 odd million bucks in property. You see? My man.
Awesome.
Anything else to wrap up?
No, I think that was good.
That was good.
Yeah, good.
That's bank v broker right there.
Bank
And
v broker.
if you think banks are better than brokers, then you need to go back to school because we were not saying that. All right, that was good.
Awesome.
We'll see you soon.
Thank you, sir.
Thanks for coming in.
Likewise.
Let's fix that curtain. This is general advice and does not take into consideration your objectives, situation, or needs. You should consider if this advice is suitable to you or your circumstances, and please read any applicable PDS beforehand. This is a Henderson podcast production.